ecosystem of innovation, a comprehensive guide to Apple Inc., AAPL. As of February 16th, 2026, Apple Inc., ticker AAPL, remains the world's most iconic consumer technology brand. While the stock has faced a volatile start to the year, including a 5% single-day drop on February 12, 2026, sparked by reports of AI software delays, it recently posted a record-breaking first quarter, with $143.8 billion in revenue. For an investor today, Apple is no longer just a hardware company. It is a massive, high-margin services ecosystem, supported by the world's most successful hardware platform. This guide explores the company's shifting revenue pillars, its high-stakes Apple Intelligence strategy, and the specific risks every investor must weigh before starting a position in 2026. 1. The two pillars: hardware versus services. To understand Apple in 2026, you must understand the razor and blade model it has perfected. Apple sells high-end hardware, the razor, to bring users into an ecosystem where they spend money on digital services, the blades, for years to come. The hardware engine, around 60 to 70% of revenue. iPhone, the crown jewel. In the most recent quarter, iPhone revenue hit an all-time high of $85.3 billion, up a staggering 23% year over year. This growth was driven by the iPhone 17 series, which convinced millions of users to finally upgrade their older devices. Mac and iPad. These segments have seen mixed results. While the iPad grew 6% recently, the Mac declined 7% due to difficult comparisons against previous years. However, the installed base for both remains at record highs. Wearables. The expansion. Products like the Apple Watch and AirPods are currently facing supply constraints. Despite a slight dip in revenue to $11.5 billion, Apple remains the dominant player in the global smartwatch and wireless earbud markets. The services engine, around 25 to 30% of revenue. This is the most important part of the investment story. Services include the App Store, iCloud, Apple Music, Apple Pay, and Apple TV+. High margins. While hardware gross margins are around 40%, services post a massive 76.5% gross margin. Recurring revenue. Unlike an iPhone purchase, which happens every few years, services revenue is collected every single month. In early 2026, this segment reached a record $30 billion in quarterly revenue. 2. The 2026 catalyst: Apple Intelligence and Google Gemini. If you are looking at AAPL today, the hot-button issue is artificial intelligence, AI. For much of 2025, critics argued that Apple was falling behind rivals like Microsoft and Google. In 2026, Apple is answering back with a two-pronged strategy. The Google partnership. In a move that surprised many, Apple recently confirmed a theme collaboration with Google to power future versions of Apple Intelligence using Gemini Foundation models. This allows Apple to offer cutting-edge AI features, like a more personalized Siri, without having to spend the tens of billions of dollars that peers are spending on training their own models from scratch. The Siri delay volatility. The stock took a hit in mid-February 2026 because of reports that the Siri overhaul, the centerpiece of Apple's AI strategy, has run into technical hurdles. Features originally expected in early 2026 may now be pushed to May or beyond. This delay has created a show-me year for Apple. The market wants to see if these AI features will actually drive a new supercycle of phone sales. 3. Financial health, buybacks, and the dividend fortress. Apple is widely considered the gold standard for capital allocation. It generates more cash than almost any other company on Earth. Key financial metrics. As of February 26. Cash position. Apple ended the last quarter with $145 billion in cash and marketable securities. Share buybacks. In just the last 3 months, Apple returned $25 billion to shareholders through buybacks, effectively cannibalizing its own shares to make each remaining share more valuable. Dividends. On February 4, 2026, Apple quietly raised its dividend to 26 cents per share. While the yield, around 4%, is low, Apple has raised its annual payout every year since 2012, making it a favorite for long-term dividend growth investors. Gross margins. The company achieved a record 48.2% total company gross margin in early 2026, proving it still has incredible pricing power despite rising costs for parts like memory chips. 4. Sector dynamics. The China recovery and emerging markets. A massive part of the AAPL story in 2026 is the geographic shift in its business. The China rebound. After a difficult 2025, Apple's revenue in Greater China surged 38% in the most recent quarter. The iPhone 17 Pro has become a status symbol that is successfully fending off competition from local brands like Huawei. The India opportunity. CEO Tim Cook has designated India as a top priority. In 2026, Apple is seeing all-time revenue in India as the middle class there rapidly adopting the iOS ecosystem. This provides a long-term growth tailwind that offsets the saturation of the US and European markets. 5. Critical risks. What could go wrong? No investment is a sure thing, and Apple faces 3 primary threats in 2026. Regulatory pressure. The FTC factor. In February 2026, the Federal Trade Commission, FTC, issued a fresh warning to Apple regarding alleged bias in Apple News and its terms of service. If regulators force Apple to lower its 30% App Store commission, it could directly hit the company's most profitable revenue stream. Valuation. The premium problem. AAPL currently trades at a forward PE ratio of roughly 31.9 times. This is significantly more expensive than the broader market average, around 21 times. At this valuation, the market is pricing in perfection. Any further delays in AI features or a miss in iPhone sales could lead to a sharp correction. Supply chain costs. Rising tariffs and the increasing cost of high-end components, like advanced AI chips and memory, are putting pressure on hardware margins. Apple is currently absorbing these costs, but if they continue to rise, the company may be forced to hike iPhone prices even further, potentially alienating consumers. 6. Strategy. How to invest in AAPL in 2026. For most investors, Apple is a core holding, the kind of stock you buy and hold for decades rather than weeks. The buy on dips candidate. Because Apple is a mega cap stock, it often gets caught up in broader market sell-offs. The recent 5% drop in February 2026 is viewed by many analysts as a buying opportunity for long-term investors, as the stock is now trading at a roughly 14% discount to its average analyst price target, $292. The AI play. If you believe that AI will eventually be invisible and integrated into the tools we use every day, Apple is the best play. They aren't trying to build the next ChatGPT website. They are trying to make your phone an AI-powered personal assistant. The portfolio anchor. Because of its massive buyback program and reliable cash flow, Apple tends to be less volatile than many other high-growth tech stocks. It acts as an anchor that provides stability during turbulent market periods. Conclusion. The long-term vision. Apple, AAPL, enters the spring of 2026 as a company in transition. It is moving from being the iPhone company to being the AI services company. While it faces near-term drama regarding Siri delays and regulatory warnings, its underlying fundamentals, 2.5 billion active devices, a $145 billion cash pile, and record high loyalty, are stronger than ever. The verdict. Apple is a quality investment. You are paying a premium price for a company with almost zero chance of going bust, and a very high chance of continuing to grow its dividends and buybacks. If you can ignore the noise of short-term AI delays, Apple remains one of the most resilient businesses in human history.